Yeah, so idle equity in your home, how can we use that? I mean,
Yeah.
idle equity in your home can be used for cash out refinances and debt consolidation. And I often think people kind of look at that as maybe a negative thing, but at the end of the day, you're in a debt situation, right? So we're already I think, in a negative place where we've got a lot of consumer debt. The beauty of maybe moving that over to your mortgage as opposed to consumer debt is I think, two things. One is you're always going to have a lower interest rate on your mortgage, and you typically are going to be on a credit card debt.
For sure.
16% versus 7 or 6 where it's at right now. But where we've been able to really look at it from a scenario in which it benefits a customer is, what is the monthly amount that the customer is paying to service that debt, right? So if it's $50,000 in credit card debt and they're paying $1,500 a month, moving that $50,000 towards your mortgage, might be $300 a month from a payment standpoint. And so what we can show them is you're already servicing that. You're already paying that $1,500 a month to service that debt. Well, what if you just keep paying that same amount, but now towards your mortgage? You've paid off all that credit card debt. It's improved your credit score. A lot of other positive benefits have occurred to you from your financial standpoint, but you're actually going to accelerate the mortgage. So now you've eliminated that debt, and if you keep paying that same payment, you'll actually pay off the mortgage sooner too. And it can save them hundreds of thousands of dollars in interest over time. So that's where I think a debt consolidation can be actually really smart and definitely improve a negative situation of having a bunch of consumer debt.
Yeah. I mean, you have so many people that they think emotionally, they think, hey, I've got this under control. I know it feels tight right now, but I've got a game plan, and me and my wife, we're going to figure this out. But in all reality, they don't see it logically. They don't see the numbers. They don't see the credit report. They don't see the minimum payments that they're just making every month. And they feel, next month I'm going to get this. Next month I'm going to get this. But it just like turns into a repetitive, vicious cycle. And sometimes if you show them, hey, if you pay off this, 25 grand in credit cards, you have a personal loan here, maybe even your $800 car payment, and just roll all that into your mortgage, even if it is a little bit higher of an interest rate than what you're currently paying, which they hate to hear.
Right.
But if you show them the numbers side by side, typically it's like, hey, that light bulb moment happens and they realize, oh, this is how I can get my life back on track. My finances back in order.
Right.
And
mitigate that debt. I think it's an opportunity. It's not for everybody, but I think it's definitely something that people should be considering.
Yeah.
And you hit it there. I mean, it's consumer credit debt is at the highest level it's been in years.
Right.
And the savings rate is actually at some of the lowest it's been in years. So I think there's opportunity to help some people with that for sure.
Everything's going like
it is.
That.
Yep.
Yeah, it's not just mortgage interest. Interest rates on everything is going up. Credit cards, car payments. We just recently bought a new car for Marie, and the interest rate was going to be about 5-6%.
Yeah.
And he was like, dude, this is the greatest deal I've seen. And I was like,
yeah, I think
wow.
it was like 4.99.
Yeah.
And we were like, oh, okay.
Yeah.
So we paid for it in cash because by the time you were factoring in everything, it was like, this is not a sustainable monthly payment.
No.
So
Yeah. I think people are just so like married to their interest rate on their mortgages, and sometimes it turns into an inhibitor or, a negative
Right.
for them.
And they can we have even second mortgages that we can do where it'll still potentially make sense to do that as opposed to paying the consumer debt. We just need to work a blended rate calculation. Does it make sense to put on the first, even if you have a low rate, and redo the first, or do we get a second mortgage? We just do a blended rate calculation, and the math will tell us what makes the most sense.
but using your mortgage as a financial tool is only an option if you have a mortgage. So I think when people are looking to buy a home, they think they need to pay off their debts. They think they need to be in a certain financial position to take on a mortgage. I think sometimes we talk about paralysis by analysis.
Yes.
People are thinking about these things and they want to get them all in line before taking on a mortgage.
Mm-hmm.
But we're seeing all the benefits that a mortgage could potentially provide somebody financially. So what steps will we need to take to get into a mortgage to be able to utilize equity to potentially pay off things like consumer debt?
Yeah, it's an interesting thing. I've talked to people like, hey, I want to buy a home once I pay off the student loans. And it's like, well, what if the home is the vehicle that can pay off the student loans? I don't think people think that way, right? But you hit the nail on the head. People overanalyze it. They think that they have to have all this in place before they're going to be able to qualify for a home loan. And in reality, I think it's a lot easier to qualify for a home loan today than potentially some of the other consumer debt that they're trying to qualify for. And so often people are making assumptions that are not accurate. And so if they're thinking about buying a home at all, just raise your hand. and talk to a lender and tell them what you're trying to do. We call it a hopes and dreams call. What are you trying to do? What's the ideal purchase price? What's your monthly budget, right? And how much do you have set aside for the initial investment? Those are really the three key things that I think you need to figure out ahead of time before talking to a lender. But purchase price goal, how much you want for a monthly payment, and how much do you have set aside for the down payment. And then from there, like that's enough to make us dangerous. Complete a loan application, takes you 10, 15 minutes. There's no upfront or out-of-pocket expenses. And let us go to work and show you options. And at the end of the day, it may not work.
Sure.
But I think if you're thinking about it, it's such a large investment, right? And a cool thing to do, like figure it out and either run down that path or put it aside and say it's for later. We'll figure out other things right now.
I think a mortgage can be a very empowering tool, but a lot of people view it as a shackle.
Right.
But I see it as a great vehicle to be able to help you achieve so many different financial goals. It's basically a savings account. You're putting your money into your mortgage. Your mortgage is, your equity is hopefully growing, especially over the last few years. We're talking about debt consolidation, being able to minimize those things. But so many people get very
Empowered.
empowered knowing, hey, this money is growing. I can actually use this money. But I think a lot of people view a mortgage as, hey, I'm going to pay this and kind of forget about it. It's its own thing. People need to learn how to make their mortgage work for them to be able to achieve different goals.
I agree.
I think everything really that we're talking about comes down to, in a roundabout way, home prices, right? Equity, home prices. From your guys' experience, taking the media in consideration, the media likes to highlight doom, gloom, the world, the sky's falling, et cetera. What are you guys actually seeing happening with home prices right now?
Personally, I'm seeing home prices continue to appreciate. If we're looking at the difference between home prices in the early Q1, Q2 of 2022 and home prices now at the end of Q1 of 2023, home prices are still up. So homes are still appreciating. Homes typically have about a 5 to 7% appreciation rate nationally, but Nashville over the last 2 years has seen maybe about a 20% appreciation rate. We're starting to see that appreciation rate dwindle, but it's still occurring. So as interest rates continue to rise, I think a lot of people had this hope that home prices would fall, it would balance out. But what we're seeing is home prices are still continuing to go up, and interest rates are kind of still going up. So it's kind of the elephant in the room that nobody really wants to talk about. But if you're waiting for home prices to come down, you're actually starting to price yourself out of the market because home prices are continuing to go up as interest rates are continuing to go up. You're going to have more money to be able to get into a mortgage. It's going to potentially cost you more money in the long haul, month over month. Just in terms of interest and your sales price or your home value alone.
Yeah. As far as home prices staying on this trajectory, interest rates not budging as of what we can see yet, Keith, do you see like programs that are being implemented that can help the first-time home buyer get into a home?
Yeah, I'm actually seeing the federal government make a lot of changes recently that directly impact the first-time home buyer in a positive way. They are trying to decrease interest rates. So from a lending standpoint, there's a thing that we do. It's called loan level pricing adjustments, but basically it's like points on your driving record, right? If you have a lead foot and a bunch of tickets on your driving record, your auto insurance is going to be more expensive. It's kind of the same thing when lending. You have all these different factors that impact your interest rate. What the federal government is doing specifically around the first-time home buyer is limiting those impacts to try to offer a lower interest rate for the first-time home buyer, which I think is a benefit for them right now. I also do think that inflation is the thing, right? If inflation comes down, interest rates will come down. We're not going to see the 2s and 3s and 4s that we had. That was a global pandemic that caused that. But to see interest rates move down from the 7s into the 6s and maybe into the 5s, I think is something that we see in the horizon. The government is also reducing some of the other costs. There's a thing called mortgage insurance. If you're not putting 20% down, it's a portion of the mortgage payment, and sometimes it can be a very large portion of the mortgage payment. We've seen programs recently where the federal government is reducing that as well. So I think there's a lot of opportunities right now for the first-time home buyer to relook at real estate from an affordability standpoint. And then also with a little bit of the lull that we've seen, there's potentially an opportunity for the seller to come to the table and also mitigate some of the costs that the buyer has, either permanently or temporarily through interest rate reduction. So I've been having this talk recently called the Year of the First Time Home Buyer, and I think the first time home buyer has a lot more opportunity right now than they definitely have had in the last 2 or 3 years in the local market.
Yeah. I mean, that's the majority of your business, wouldn't you say? First-time home buyers?
I would say the majority of my business is either first-time home buyers or it is relocation clients. But there have been so many instances over this past year where I've seen people who thought home ownership was unattainable, who saw that home prices were going up, interest rates were going up, there's no way they were going to be able to make it work. But we were able to lock them into a home where the seller paid off their closing costs. They used down payment assistance and virtually bought a home with $0 out of pocket. The money that they put in up front for an earnest money deposit was then refunded back to them at closing. So they actually walked away with a check. And Paul and I would have this conversation. Paul would say, I just don't think it's a good financial sense for them. And then we're talking through the process, like, how are these buyers achieving these goals? And is this really a beneficial move for them? And in all of these cases, it has been.
She's got crazy stories. Last year, she's helped clients where from a lender's perspective, I was like, there's just no way this is going to work. I was like, that's a high risk move for them. They should probably think about waiting. And she finds a way, because she gets these conversations started because they reach out to her via her Instagram. And just like you said, it's just a phone call. Just have a phone call. She directs them to a lender, and these lenders are able to find programs, first-time home buyer programs, down payment assistance, and get these people into homes. And literally, it's like the craziest story. And, very emotional, actually. You've got some home buyers that I'm like, wow, there could be a book written about this story right here.
Yeah, I think it's all about who you work with. Who you work with is a huge part of the process, because not only are you working with this person, you're also using their wealth of knowledge. Mm-hmm. And if you're working with somebody who knows about these programs and know that they exist and can find opportunities to connect people with beneficial programs, that's a huge key. A lot of these people got told they couldn't buy a home. Right. Other agents wouldn't want to work with them or wouldn't want to take them on. We would be in the middle of the purchase process and a lender would say, nope, can't do that. But it's just all about being flexible and then being able to make game time decisions. But we're only able to do that when we know about these programs, when we know about these people who are able to offer these things.
Sure.
I think when it comes to mortgages, Keith is one of the most knowledgeable people that I know when it comes to mortgage programs, insight and forefront when it comes to mortgages. But you've told me a lot of things. I've watched a lot of your videos and content. I feel like I'm then able to relay that onto clients to potentially get them into a home where it may not have been possible previously.
So big, because coming from, the big box lenders that I did, when you would bring up these situations, I would use my experience and just immediately write it off, because we never offer those programs. And then all of a sudden you're talking about these programs being offered to your clients that I'm like, what? I've never done that, or I've never seen that.
Yeah, like 1099. He's like, nope, they can't do it. And I'm like, I know that there's programs out there. Yeah.
Well, I think, specifically with first-time home buyers is, every state is so different in terms of what is offered for first-time home buyer from an assistance standpoint, state to state to state. And some programs are only in these states or only in those states. And so if you are with one of those big box lenders, not to disparage or say that they don't know what's going on, it's just they're looking at it more from an all 50 state standpoint. Yeah. Whereas when you're working with somebody who's local to the area, a real estate agent, a loan officer, they know the products that are available specifically in that area.
100%.
And sometimes the programs are city specific, city and county specific. And so I think especially as a first-time home buyer, when you're looking to buy a home, local is way better than going more global for the support that you're getting.
Sure. 100%. And that opened my eyes after seeing Marie work with local lenders, because when I was doing mortgages, we never offered these programs because we were a national lender. And when clients would come looking for them, we would just tell them, if they didn't meet all the boxes and check all the boxes that were very nationally blanketed, we would just tell them, you can't do this, or you're going to have to wait, or you need to get your savings up to this point, et cetera, your credit up to this point. And they would be discouraged. And I thought how much of an impact it makes to talk to the right person who's going to give you the right information to help guide you in the right direction. It's going to make all the difference. Talking to one lender to another, from one lender to another, could be the difference between getting into your home or just feeling like you can't do it and just waiting forever.
It's not always easy,
No, it's not.
but it's always worth it.
So relocation.
It's relocation season.
It is relocations. It is relocation season.
Springtime.
And in relocation season, I think if in your tool bag all you have is a hammer, everything looks like a nail.
Mm-hmm.
And so I think from a relocation standpoint, strategy is so important because there's so many different variables when someone is relocating not only their family but their finances to another state. And there's some things that people don't necessarily think about, and the primary thing is job. We have the conversation a lot, and so I guess a couple of things you should be considering if you're thinking about relocating is what is the job situation going to look like with the relocation? Number one, can you work remote? If you can't work remote, we have an income problem because I can't use if you're moving from California to Tennessee, that's not a reasonable daily commute, right? Yeah. And so we need a letter from the employer indicating you can work remote. That's perfect. That's one of the easiest ways to get through that. The other thing is if you're relocating to a new job, we really need to go through that, and that job needs to be in place ahead of time. But you don't necessarily need to start the job, and I think that's where sometimes people get confused. You can actually have an offer letter from that employer, and as long as it's non-contingent, meaning there isn't anything that you need to do before you can start, like a background check, right? Or maybe some sort of state licensing that's required to be able to operate in the position that you're going to operate. So I think those are that's the biggest thing is what is the job situation? What's the income situation going to look like in that relocation? Do you have a new job already lined up, or can you work remote? That's the big thing.
Yeah, I get an influx of people who are reaching out to me about relocating to Tennessee. Hey, I want to make the move to Nashville. What do I need to do? And the very first question I usually ask is, tell me about your job, because I know that's going to be a huge factor. And then from there, it's, all right, let's get you connected to a lender because you guys have the most insight about this, because anybody can make the move, anybody can have a job, but when it comes to all these requirements to securing your mortgage, the financial piece is so specific. So I'm like, talk to Keith, get some things in place before we start taking looks at relocation trips or specifics, because a lot of times these people are looking at homes on Zillow, homes online, looking at these mortgage payments. Oh yeah, I can afford that.
I can afford that with my current job.
Yeah, well, that's not even
Does that
showing.
income translate?
Yeah, the income translation, the down payment translation, online mortgage calculators can be a great tool, but a lot of people use them incorrectly. So, step number one.
Talk to a lender.
Every time. Everyone, I want to buy a home. Great. Let's get you connected to a lender. And then they're like, oh, well,
It's the most important piece of the entire transaction.
100%.
If you're going to finance it, we got to figure that out because we can be looking at the wrong homes and that not on the right timeline as well.
I've had some lenders say, oh, it's too early to reach out.
Never.
I'm like, no, I want you to reach out, get an idea of what a range could be. If there's anything that we can do to make this more solid for you, then let's go ahead and start making those moves. But the lender conversation is the biggest conversation that you have when it comes to buying a home.
What are requirements as far as time and the different kinds of income, whether it's W-2, commission, 1099, self-employment? How long do they need to have held that position?
It's a really good question and can be quite in depth. I mean, the easiest thing is a salary job. If you have a salary job or a set hourly job, that's a really easy transition, and we can document that. It's when it's variable in nature that we sometimes have trouble as a lender. So commission-based is a great example. And especially if you're relocating from one company to another and then we have this new job, how is that income, your historical income, going to translate to the new job that you're working at? And sometimes it doesn't. And so it's hard to put kind of a blanket, oh, it's got to be 6 months or it has to be a year. It's each individual situation is unique to the person. There are times where you can relocate from California to Tennessee and change jobs, and you're good day one. There's other times where we're going to say you need to be on that job for 6 to 12 months based on your situation and your historical income. And I think that's why it's so important to talk to the lender.
Yeah, when people reach out and I say, hey, talk to a lender, that usually gives me an idea of
Right.
are we going to be searching for homes right away? Or do we need to be looking for short-term rentals or long-term rentals? I think having a lender in your back pocket for relocations is the biggest tool that you can have in your toolbox, because that's going to give you the momentum and direction and what are my next steps.
Yeah, and I think people consider when they're thinking about the lender, it's like, well, I'm not ready for the mortgage right now, and well, that's our job, is to help facilitate the mortgage. But there's a lot of other things that we're here for, and one of those is to help people think about things that maybe they wouldn't have thought about before, and then just to answer questions. You have a lot of questions going around your brain when you're thinking about relocating from one state to another state, and our job is to just answer those questions, give you the information so that you're empowered to make the decision. The decision may be, well, we're just not going to relocate. It might be we're going to relocate now. It might be 2 years. Doesn't matter. Our job is to help people get information so that they can have what they need within such a large decision.
Sure.
Yeah. I feel like people are so intimidated by the act of calling a lender or having a conversation with a lender.
Sure.
Like they think it's such a huge commitment, and it's really not. It's just getting information. It's 9 times out of 10, it's so enlightening just to understand like what you qualify for, what the picture could look like for you.
Right.
So, yeah.
I think some people might feel very vulnerable talking about their finances.
It's wild. I mean, if you think about it, in the first 15, from your lending experience, in the first 15 minutes of conversation with someone, we literally have everything. Like,
Yeah.
we get more information in the first 15 minutes of conversation with a customer than a financial advisor gets that, has a customer that might be investing $5 million with them.
Yeah.
With a first-time home buyer buying a $400,000 home. It's wild what we get, and so I can see how that process would seem vulnerable,
Sure.
and intimidating.
But it's empowering.
But it's empowering. It's empowering to have a plan.
Yeah. And the lender, you guys get so much information. Your guys' relationship is so much deeper than even with the realtor. And the realtor is the one spending all the time, like
Right.
looking at the houses. When Marie was showing houses to clients, I'd be like, oh, what do they do, for a living? Sometimes she wouldn't know. And I just wanted to like ask all these questions that
Right.
I thought were just like, these are transactional questions. But yeah, I guess the relationship is just very different.
It's way different. The relationship that we have is one that's more based on numbers and facts and that transaction. We try to have kind of that emotional connection with customers, and I would love to have it more. We do not have the relationship that you. I mean, you're talking hopes and dreams. There's crying and
I know.
and laughing and tears. And
I don't want there to be crying.
I know, but you know what I mean. Though.
But-
Like, tears of joy too.
Yeah.
Right?
Tears
of joy.
There's
You've
all,
had tears of joy.
Yeah, there's
Yeah,
all kinds of
sure.
stuff that you go through in a very short, intimate period of time. A lot of us is it's the numbers, but look,
She was doing a dance in her PJs last night because she had a contract offer over ask price, and she was just
Yes.
doing the
yes,
Yeah.
living room
well,
dance.
we
yeah.
should insert that photo.
Yeah.
in the video at that
I
moment.
think
Yes.
Paul even got it
I
on
got it on-
video.
I got
so
it on
if you
video.
want that
Perfect.
clip,
Perfect.
that might.
Can you imagine? So good. Let's get into it. Trust income, right?
Yep.
So trust income is a very creative way to use the cash that you have as income to qualify. As a lender, we are required to document your ability to repay the debt. And just having cash is not documenting that ability to repay the debt. We understand that you could pay cash for the house. We understand that you can withdraw that money on a monthly basis, daily basis to subsidize that payment if you need to, but that's not a form of income that we can use. A really creative way to take that cash and make it a form of income a lender can use is put it in a trust. So under conventional FHA, VA, and some jumbo programs, there is no historical receipt requirement of trust income, meaning you don't have to receive that income for a 6-month, 1 year, or 2 year period of time. You can literally create a trust, fund that trust with those assets, and then start taking distributions off that trust on a monthly basis, and we can use that as qualified income.
Wow.
So where it really helps is in the relocation situation. You've got buyers in different states that are selling a home and netting a whole bunch of cash, but may not have the same income on a monthly basis as they had in their other state, or may have no income. And so instead of putting all the money down on the new purchase, maybe we preserve some of that money back to fund the trust to generate income. And then in other situations, it's just, do we not have enough income to qualify and they have a bunch of cash? So we could use trust income as the total income, like all of the income we're using to qualify, or just a small portion to make sure that they can qualify.
So like those commission jobs we were
Yeah.
talking about, maybe those more unconventional
Right.
jobs, which I feel like is going to be such a key component moving into the market going forward because gig work is becoming more and more prevalent. Commission jobs, all these work from home jobs where people aren't receiving
Contract jobs.
standard
Yeah.
W-2 pay. I think it's the easiest time to be able to buy a home right now with all of these first-time home buyer incentives, if you will, but also, you know, mortgages are becoming a lot more accessible for people who don't have standard pay through things like this.
I think, and trust income is a great way to make it work.
Yeah.
And at the end of the day, I think if you have assets and children, you should have a trust. I'm not a trust attorney, right? I can't give trust advice, but at the end of the day, like the trust protects the asset and protects your children. I think you should have one anyways.
Sure.
And then it can be the vehicle that helps you get qualified for a home loan if you have a bunch of cash.
Yeah.
Keith, do you feel like there's anything that consistently or kind of frequently catches your clients off guard when it comes to a mortgage? Anything that might pop up from left field? And
The extras. So you talked about this earlier, one of those being the total payment. You know, if you're going on Redfin and Zillow or those different online resources to generate a payment, often they're missing things in the payment. The property taxes are not being calculated accurately or not in there at all. The homeowner's insurance may not be in there, and then often the mortgage insurance is inaccurate. And so when a customer says, "Oh, I'm looking at this $350,000 home," and they're in their mind they're thinking it's going to be X payment, it could be completely different.
Yeah.
So the second one is the extras in terms of cash to close, right? You know, it's not just the down payment, their closing costs. And so there's usually another 2% or so on top of the actual down payment that's needed to close. And so, you know, you have appraisals and home inspections and pest inspections and all those other things. And so I think it's really important to go through that in detail to make sure that you have all the money set aside that's needed. Those are the two surprises that I think people have.
So it's HOA payments
HOA payments.
every
Yeah.
time.
The lovely HOA.
I know. What a time. What a time.
what about clients that, let's say you have a married couple, they have, you know, excellent credit, let's
Okay.
say 760 plus,
Sure.
they have decent paying jobs,
Okay.
they have a little bit of savings.
Okay.
Do you have a suggestion that you make towards down payment? How much? Or do you just let them decide on their own?
I think it's a budget based, so it's part of that first conversation. What's the ideal purchase price? How much do you have set aside, and what would you like for your payment? And then my job is to try to go back to our war chest, if you will, and try to find programs and options that fit that as close as possible, and then come back and say, here's what we got, and then start pivoting from there. So it's a hard. I can't put like just a blanket answer to that,
Yeah.
but I think coming up with that plan ahead of time is important for sure.
Do you see more people go for a minimum down payment, or do you see more people
That's
wanting to
fine.
put a lot more
Yeah.
down?
So I think people think they need to put 20% down to buy a home.
Yeah.
And there's so many programs that you don't have to do that. There's down payment assistance, there's USDA, there's VA, FHA. I mean, the programs are endless to do that. But I think people have in their mind this amount that they're supposed to save. I would also almost argue to say that even if you have the 20%, I don't know if you should put it down. Because there's a lot of different ways, and we can show this through graphs where if you put the 5% down, take that extra 15 and then invest it elsewhere, and then look out 20 years, your net worth will actually be greater by doing that. So some of the recommendations we make are also going to be based on just the comfort level or the comfort of the risk level that a customer has.
Yeah.
Just because you have the 20%, I don't know if you necessarily should, but if that's what they want, we're definitely going to show them the option. But like I said before, I think my job is to help them think about things that maybe they wouldn't have thought about
Right.
and
Thinking.
present things.
Yeah, in
Yeah.
2021, the average down payment for a first-time home buyer was around 7%. So more and more people are opting for lower down payment options. I think,
Right.
especially the younger of a buyer, the smaller down
Yeah,
payment.
and there, you know, you have a 2, 3, 4% 30-year fixed interest rate that you're getting, and then the money that you have is, you know, netting you 6, 8, 9, 10, 12, 14%. Why are we taking that money out of a 4% return to mitigate a 5 or 6% interest rate
Right.
that also you can potentially write off?
Mhm.
So again, it's everybody's individual scenario. But like I have a CPA that works with really high net worth people, and the clients will call me and says, so-and-so asked me to call you to get a home loan, and I'm supposed to tell you the interest rate doesn't matter. Because the CPA is looking at saying, hey, this is a larger write-off, right? That we're going to use these funds, and we know that you're using your money and investing it elsewhere. So
13%
right.
interest rate right off the bat.
Let's go.
Yeah.
Yeah. I don't
Great.
mean to say that
Yeah.
flippantly, that
Sure.
interest rates don't matter, but I guess the point is that we need to think about it differently.
Yeah. Can we talk about PMI? Because so many people, when they hear PMI, they have like this cringe feeling. Oh, I don't want to pay PMI.
Sure.
PMI's, PMI's evil. Realistically, on a kind of a normal transaction, whatever normal is, what would you think PMI would be?
Well, I mean, if we say normal transactions grab a $400,000 purchase price, depending on the borrower's credit qualifications, your PMI could be anywhere from $150 to $300 a month, kind of in that range. So PMI is very much like auto insurance, right? The better driving record, the cheaper the insurance. So better credit score, more savings, longer time on job. That mortgage insurance can be less expensive or more expensive. But again, and I've said this before, PMI is a tool, right? And so it's not a bad word. It's an opportunity to buy a home with less than 20% down. And I think there's a lot of people that were saving for 20% over the last 4, 5, 6 years, sat on the sidelines, and the amount that they thought they were saving by saving 20% down, they lost based on how much the home is actually appreciated.
Inflation.
Yeah. So it's an opportunity. It's not a bad thing. If you have the 20% down, you're going to mitigate a large cost associated with purchasing a property by eliminating mortgage insurance, but also just having a larger down payment. But it's not the only way.